The primary dealer system plays a vital role in the functioning of U.S. Treasury markets and the implementation of monetary policy. This video will explain how the primary dealer system works and explore hypothetical scenarios where primary dealers might be unable to support a Treasury bond auction. The primary dealer system is a network of financial institutions designated by the Federal Reserve Bank of New York to serve as trading counterparties in the implementation of monetary policy and the distribution of U.S. government securities. These institutions act as market makers, providing liquidity and facilitating the smooth functioning of the Treasury market. Primary dealers have several important responsibilities. They are required to participate in all Treasury auctions, ensuring a base level of demand for new government debt. As market makers, they provide continuous two-way quotes, bid and ask prices, for Treasury securities, enhancing liquidity in the secondary market. Primary dealers also execute open market operations with the Fed, helping to implement monetary policy. Additionally, they offer valuable insights and information to the Fed about market conditions and trends. The Federal Reserve Bank of New York carefully selects and monitors primary dealers. As of June 30, 2022, there were 24 primary dealers, including major banks and securities firms. To become a primary dealer, institutions must meet strict criteria related to capital requirements, trading capabilities, and compliance standards. Treasury auctions are a critical component of the primary dealer system. The process typically begins with the Treasury announcing the details of an upcoming auction, including the amount and type of securities to be sold. Primary dealers then submit competitive bids, specifying the quantity and yield they are willing to accept. The Treasury allocates securities to the highest bidders until the entire offering is sold. Following the auction, primary dealers distribute the securities to their clients or hold them in their own inventories. After the auction, primary dealers play a crucial role in the secondary market. They make markets by quoting prices at which they will buy or sell Treasury securities, facilitate large trades for institutional investors, and provide liquidity by standing ready to buy or sell securities, even in times of market stress. Primary dealers are key counterparties in the Fed's open market operations. They participate in repurchase agreements, repos, and reverse repos with the Fed, and may be involved in the Fed's asset purchase programs, such as quantitative easing. They also provide market information and analysis to the Fed's trading desk. While the primary dealer system has generally functioned well, there are potential scenarios where these institutions might struggle to support a Treasury bond auction. Here are 10 hypothetical black swan situations. 1. Global financial crisis 2.0. Imagine a severe financial crisis, even more intense than the 2008 meltdown. In this scenario, multiple primary dealers might face severe liquidity constraints due to losses in various markets. Their ability to take on new Treasury inventory would be severely limited, and some dealers might even face bankruptcy, reducing the number of participants in the auction. In this situation, the remaining dealers might be unable to absorb the full auction amount, potentially leading to a failed auction or significantly higher yields. 2. Sudden interest rate spike. Consider a scenario where inflation unexpectedly spirals out of control, forcing the Federal Reserve to dramatically raise interest rates. The rapid increase in rates would cause significant losses in primary dealers' existing bond portfolios. The prospect of further rate hikes would make dealers hesitant to take on new long-term debt. Moreover, client demand for treasuries might plummet as investors seek high-yielding alternatives. This could result in weak demand at auctions, with dealers unable or unwilling to step in and fill the gap. 3. Cyber attack on financial infrastructure. Envision a sophisticated cyber attack that targets the financial system. Trading systems of multiple primary dealers could be compromised, and the auction platform itself might be affected, disrupting the normal bidding process. Uncertainty about the integrity of financial data could cause a freeze in market activity. In this case, even if dealers want to participate fully in the auction, they may be technically unable to do so. 4. Geopolitical crisis and flight from U.S. assets. Picture a major geopolitical event that shakes confidence in the US government. Foreign investors, including central banks, might rapidly sell off US treasuries. Primary dealers' balance sheets could be overwhelmed with existing inventory, and there might be a widespread reluctance to take on more US government debt. This scenario could lead to a situation where dealers are unable to place bids at yields acceptable to the Treasury. 5. Regulatory overhaul and capital constraints. Imagine a swift regulatory change that significantly increases capital requirements for primary dealers. Dealers might be forced to reduce their treasury holdings to meet new capital ratios, and their capacity to underwrite new debt could be severely constrained. Some institutions may choose to exit the primary dealer business altogether. This could result in a reduced capacity of the primary dealer system to support large auctions. 6. Liquidity crisis in repo markets. Consider a severe dislocation in the repurchase agreement (repo) markets. Primary dealers could lose a key source of short-term funding for their treasury positions, and the cost of financing existing inventories might skyrocket. Dealers might become unwilling to take on new positions due to funding uncertainties. This scenario could lead to reduced participation in auctions and potential market dysfunction. 7. Crisis of confidence in fiat currencies. Envision a worldwide loss of faith in traditional fiat currencies. Investors globally might shift to alternative stores of value, such as cryptocurrencies or precious metals. Demand for government securities could plummet across all investor classes, and primary dealers might face challenges in distributing treasury securities to end investors. In this case, dealers might be left holding large amounts of unsold inventory, impairing their ability to bid in new auctions. 8. Natural disaster affecting financial centers. Picture a major natural disaster striking key financial hubs. The physical infrastructure of multiple primary dealers could be damaged or inaccessible. Key personnel might be unable to perform their duties due to the disaster's impact, and communication and trading systems could be disrupted. This could result in a significant portion of the primary dealer community being unable to participate effectively in auctions. 9. Collapse of a major primary dealer. Imagine the sudden collapse of one of the largest primary dealers. The failure could create a ripple effect, causing losses and liquidity issues for other dealers. Confidence in the primary dealer system might be shaken, and the remaining dealers could struggle to fill the gap left by the collapsed institution. This scenario could lead to reduced overall capacity in the primary dealer system and potential auction failures. 10. Extreme market volatility. Consider a period of unprecedented market volatility across multiple asset classes. Primary dealers might struggle to manage their risk exposures, and extreme price swings could make it difficult to accurately price treasury securities. Dealers might become hesitant to take on new positions in such an unpredictable environment. This could result in reduced bidding activity and potential dislocations in the auction process. The primary dealer system is a crucial component of the US Treasury market, providing liquidity, facilitating price discovery, and supporting the implementation of monetary policy. While it has proven resilient over many decades, the hypothetical scenarios outlined in this video illustrate potential vulnerabilities that could, in extreme circumstances, undermine the system's ability to support Treasury auctions. It's important to note that the Federal Reserve and the US Treasury have various tools and contingency plans to address market disruptions. These include emergency lending facilities, changes to auction procedures, and coordination with other central banks. Additionally, the diversified nature of the primary dealer system, with multiple institutions involved, provides some inherent resilience. Nevertheless, these scenarios underscore the importance of ongoing vigilance, robust risk management practices, and continued efforts to enhance the resilience of financial markets. As the global financial landscape evolves, so too must the systems and practices that underpin the world's most important government debt market. If you found this video informative, don't forget to hit that like button. It really helps the channel. And if you want to stay updated on our latest content, make sure to subscribe and ring that notification bell. We'd love to hear your thoughts, so drop a comment below. Your engagement keeps this community growing, and we appreciate every single one of you. Thanks for watching, and we'll see you in the next video.